And hello once again, options traders. Well, a question that I get a lot from traders is what's an aggressive vertical spread? What is it that makes it aggressive versus one that's maybe less aggressive? And yeah, this video is more about semantics and definitions, but they're important to know because I will talk about, well, in this situation, you want to make the spread more aggressive, or maybe you would want to make it less aggressive. And unfortunately, a lot of traders think that they understand what these terms mean, and they usually get them exactly backwards. And of course, that can cause some really big problems. So let's take a closer look at it. What's an aggressive vertical spread? Well, recall, first of all, what is a vertical spread? If you're not familiar, I do have other videos in this forum on vertical spreads. But it's a strategy where you are going to buy one strike and sell another. Both have to be calls or both are puts. They have to have the same expiration. So for instance, if you buy the 100-105 vertical call spread, that one happens to be a debit. So the reason that it's a debit is the word buy. Whenever you buy something, it's going to be a debit. But we can also figure out which strike you must be long and which you must be short. So if you recall from some of the pricing principles that we've talked about, lower strike call options have to be worth more money, assuming the same expiration. So we know that the $100 call is going to trade for a higher price than the 105. So in this instance, you are buying the 100, selling the 105, and that's why it is a debit. On the other hand, if you sold the 100-105 vertical call spread, that would be a credit. It's just the opposite of the debit, so obviously it's got to be a credit. But we could also figure out it's a credit by the word sell. If you are selling a spread, it's a credit. In this case, you must be selling the more valuable strike. That's what's creating the credit. The thing that you're selling, the option that you're selling is worth more money than the one that you're buying. So those are the two basic types of vertical spreads. They can all fall under either the debit or the credit umbrella. But the thing that we want to figure out in this video is what makes these aggressive. What is it about these strikes? What are we doing with these strikes relative to the stock price that's making these aggressive? Well, let's go have a look. Here is a profit and loss diagram for a 105-110 vertical spread. We're going to start with the debit spread. As I always show, we get our bends at the strikes. So we can see that this is the 105-110. Let's just say that the stock is down here maybe at 103. So notice that without getting into details or volatility and things like that, it's not really a far stretch to think that you've got a pretty good chance of making maximum gain. And in fact, if we overlaid a bell curve, remember that the bell curve sits over the current stock price. There's always an implied bell curve, the potential distribution of stock prices. And the center is right at the current stock price. So it's telling us all of the potential stock prices we could have at expiration. So notice that this strike right here, the short strike, the area of maximum gain, pretty good chance we're going to see that according to this bell curve. So from a vertical spread standpoint, this is not real aggressive. And unfortunately, what a lot of traders think is the fact that they might be able to lose a lot. And this is why they get the answer exactly backwards. They'll say, oh, this is an aggressive spread because I could potentially lose a lot. And again, that's really exactly backwards. What makes a debit spread aggressive is if you are moving the strikes away from the current stock price. So if we did this, for instance, the stock is down here at 103 and we buy the 130-135 vertical spread. Now you can see that we have a very low chance for this maximum gain. We have a very high chance for the maximum loss, albeit a relatively small one, but that's just risk and reward. Remember, as you're putting on riskier trades, yes, you're going to spend less, and that's why this blue line is shifted higher. And again, unfortunately, many traders think, oh, I don't have the ability to lose that much, and therefore it's not that aggressive. Absolutely wrong. The fact that you don't have a lot to lose means it's high risk. And that's what's making it aggressive. That's what's giving you the potential for more reward. That's why this red line in the max gain section sits higher than the blue. Now we can also make a spread more aggressive by widening the strikes. So here in red, I've got the 130-135 vertical. What if we bought the 131.40? It's going to be even cheaper and potentially have even more reward. This is an even more aggressive debit spread. So the thing that I want you to think about, probably the easiest definition, is that an aggressive debit spread simply means it is a high probability for the maximum loss. And the higher that probability, whether it's because you move the strikes further out and or because you widened the distance between the strikes, it is becoming more aggressive. So what do you suppose would happen if we were trying to figure out what makes a credit spread aggressive? You might think it's the same thing, but it's the opposite. So take a look here. Let's say that we sell the 65.70 put spread. So we see the bend at 65 and at 70. It's still a bull spread. We're just selling a put spread. So we're still to the bullish side, but we're going to keep the stock price up here at 103. So notice that we have a very high probability for the maximum gain. And that's why the maximum gain is fairly small. So that's not really an aggressive vertical spread. You're not really taking a lot of risk by putting the spread on. Think about it. If the stock is 103 and you sell the 65.70 put spread, you're kind of thinking, well, big deal. Not really a lot of risk. It's so far out of the money. It's a very high probability trade, and that's why the reward is very small. But what if we move the strikes closer? So now you can see that we have a much higher probability for this maximum loss. So for the credit spread, we actually had to get closer. So still with the stock at 103, yes, we're at maximum gain, but not too far from starting to head into losses. And it's certainly not unreasonable to think that we could hit maximum loss. That's what's making this aggressive. See, once again, traders often look at this blue curve and they say, but look at the maximum loss you could take. This is a very aggressive vertical spread. No, it's not. It's a high probability for success spread. So once again, the best definition to think of an aggressive spread, whether you're talking about debits or credits, is to just use the definition of a high probability for the maximum loss. So as before, if we had widened these strikes out, maybe if we sold the 60-70 spread, we would get even less money and we would have potentially a larger maximum loss. And that would have a very high probability for that. So that would be even more aggressive. So the main thing to remember for your vertical spreads, the higher the probability for the maximum loss, the more aggressive the spread. So for debit spreads, it means the strikes are moved further out of the money and or that they are also widened. It's always about the higher probability for maximum loss. For the credit spreads, it's just the opposite. The strikes are moved closer to at the money and or widening out those strikes. So it can get confusing, but if you always fall back to this definition, the higher probability for maximum loss, you'll always be able to remember which spread is more aggressive. And understanding these basic terms and trading terms is a big step towards understanding your strategies. And for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a technical analysis course. You can find it all at optionsatoz.com. Also, please join us on the Facebook trading group, Options A to Z, and you can find a link in the description below.